Hi, my name is Nicole, and this video is about implied volatility. Have you ever nailed the direction of a stock move only to lose money on your options trade? If so, you are not alone. The culprit? A hidden force that silently eats into your profits, implied volatility. Most traders overlook it, but if you're trading options without understanding how implied volatility works, you're basically lighting your money on fire. In this video, I'll break down what implied volatility is, why it matters, and how you can use it to your advantage so you can stop making costly mistakes and start trading smarter. Let's begin by hopping into the Thinkorswim trading platform, and I want to compare and contrast the option premium in two different stocks with very similar prices. So the first stock we're going to look at is Visa. And you can see here that Visa experienced a little bit of volatility in April with the rest of the market, but has since been trading fairly steady, reaching all-time highs just recently. And when I bring up the option chain for Visa, we're going to see that the stock is trading at $357. And I want to open up the June 20th, 2025 expiration cycle. And I want to highlight here the 360 strike call option on Visa. And I want to compare and contrast this call option to the 360 strike call option in Tesla in the same expiration cycle so we can see what implied volatility does to those option values. Now, this expiration cycle has an overall implied volatility of 24.22%. We can see that the call here is trading at $8. And the implied volatility for that call option individually is 21%. Now let's bring up Tesla here. And I want to take a look at the one-year daily chart. And we can see that Tesla's been much more volatile. It reached highs in early December of 2024. It corrected over 50%, bounced around in early 2025, and has since found its footing and is retracing that move somewhat. So Tesla here is trading at $338, $20 cheaper than Visa. So the 360 call is going to be further out of the money. And we can see here that this particular expiration cycle is trading with an implied vol of 68%, so quite a bit higher than Visa's. And this individual call option implied volatility is coming in at just shy of 59%, so much higher than that of Visa's. And the price of the 360 strike call option is $14.90 at the time of this filming, almost twice that of Visa's 360 call option. And that is due to implied volatility. So implied volatility is the market's best guess at how much a stock's price will swing in the future. Many people think of it as the market's fear or excitement meter. Higher implied volatility equals higher option prices, and lower implied volatility equals cheaper options. It's that simple, but the implications can be huge. An option's price is made up of two main parts: intrinsic value and extrinsic value. Intrinsic value is how much of the option's value is worth if you exercised it right now. Extrinsic value is the portion of an option's premium that exceeds its intrinsic value. It represents the potential value of an option beyond its immediate exercise value, and it's driven by factors like time decay, implied volatility, and interest rates. Have you ever bought a put option with the assumption that a stock price would go down only to watch the stock price go down while the value of your put option remained unchanged or even went down at the same time? This is likely due to changes in implied volatility. Implied volatility can completely flip your trade from being profitable to losing, even when you're right about direction. I want to illustrate this point by taking a look at Microstrategy. I have a 3-year weekly chart pulled up here, and we can see that in late 2024, Microstrategy's price appreciated dramatically in a very short period of time. It topped out at $543 per share, only to correct over 50% from that price in early 2025. So let's assume that we were able to cherry pick the data here, and the stock topped out on November 21st of 2024. So I have that populated in the Think Back tab. And if we take a look here at the implied volatilities for the February 21st, 2025 expiration cycle, we can see that on the put side, the out-of-the-money puts were trading very rich with implied volatility over 160% throughout. And if we compare that to the call side was even richer, with the calls trading at implied volatilities higher than 170% for the out-of-the-money calls. Now let's populate purchasing a 400 strike put option in this expiration cycle. And I just want to look back in the chart here and make sure that that expiration cycle captures the worst of the down move for this illustration. And it's going to be close. These are weekly charts, so it may not capture the worst of the down move. And I want to make sure we do that so we can see what happens to those put options during the worst of the selling. So the March 21st, 2025 expiration cycle will definitely capture all of that down move. So we're going to go ahead and populate purchasing 400 strike put option for that expiration cycle as well. We can see your implied volatility is just as high, 160% for that strike. And now let's move forward in time. So let's move forward into mid-December, and we can see that the put options are mildly profitable. And we're going to move forward through December. Okay, and it looks like they're losing their value. Let's jump forward to mid-January, and you can see they are showing an unrealized loss there of over $3,000 per put option. What happened there? Okay, mid-January we saw the price of Microstrategy rebound quite a bit. So we would expect those puts to lose value. And now let's move through the end of January. We can see that the puts are still showing unrealized losses. As we move through February, we know from looking at the charts that Microstrategy was actually selling off, but yet those puts are showing unrealized losses, not gains. And here we are, February 21st, 2025. And we can see here that Microstrategy is bouncing around between $300 a share and $220-ish a share. So prices had sold off dramatically from the time we purchased those 400 strike put options. And those put options are now in the money, yet they're showing losses as the selling accelerated. And that is due to two factors. One would be theta decay, and the other factor would be implied volatility coming down. So as the stock price sold off, implied volatility actually went down. And that's why the value of the put options did not go up. And if we take it through expiration for the March 21st, 2025 400 strike put option, we can see that that put lost value as well. So even though Microstrategy sold off dramatically, immediately after the day that we bought the puts, on the day that it made all-time highs, those puts never really made much of a profit. And I remember, looking at this stock during that time, and traders who were trading this knew or remember how much implied volatility really fell off during the selling of Microstrategy. So a unique stock. A lot of times with typical stocks and selling, implied volatility actually goes up when the markets sell off, but not for all stocks, and we'll talk about that in a second. Let's talk about some popular trading strategies and what they need from implied volatility to be profitable. First, let's talk about simply buying calls and puts. After you buy a call or a put, you want implied volatility to increase. Rising implied volatility inflates option prices, so that would make your position profitable. And even if the stock hardly moves, rising implied volatility can still make you money. Now let's consider shorting straddles or strangles. After selling the options, you want implied volatility to fall. Because you've sold options, falling implied volatility deflates prices and your positions become profitable. You're betting the stock will stay calm, and falling implied volatility confirms that the market participants agree. Now let's talk about the meme stock phenomenon. Meme stocks break all of the normal rules. The options on these stocks can behave completely differently, and understanding this can save you thousands of dollars. Typically, implied volatility and stock price often move independently. So if a stock sells off, implied volatility goes up and the value of options becomes richer. On meme stocks, they're joined at the hip. When the stock price moves up, implied volatility typically explodes higher too. And conversely, when the stock price moves down, implied volatility tends to move lower. And we saw that in the example of Microstrategy. Here's the exciting part with meme stocks. This same phenomenon creates super profits for call buyers when meme stocks surge. The stock price goes up and implied volatility explodes, creating a double boost to call option values. Additionally, more experienced traders who anticipate an explosive move may choose to marry their shares with long put options. When the stock price explodes, the put may also make money. The trader may then try to capitalize on high implied volatility by selling covered calls against the long shares, while turning the long put into a put debit spread by selling a put below the strike price of the currently held long put options. I like to think of implied volatility as the market's psychology report. When implied volatility falls, the market is saying we expect the stock to stay calm. Options prices deflate like a punctured balloon, and this is great for traders who sold option premium, but tough for traders who bought options. When implied volatility rises, the market is saying buckle up, things could get volatile. Option prices inflate like a balloon, and this is great for options buyers, but can be very painful for options sellers. It's important to remember that with options, you're not just betting on direction, you're betting on the market's emotional state about that stock. Now let's talk about some practical applications. So how do you use this? Well, here's a little action plan. Before getting into any options position, ask yourself these 3 questions. Is implied volatility high or low historically for this stock? If implied volatility is historically low, you may want to consider buying options as opposed to selling options. Number 2, do I expect it to rise or fall? So do you expect the stock to rise or fall, but also do you expect implied volatility to rise or fall? Is there anything on the horizon from a news perspective or an announcement perspective that may influence implied volatility? And third, does my strategy benefit from rising or falling implied volatility? For buyers, you want to look for opportunities where implied volatility might spike. This includes earnings announcements, FDA approvals, and other major announcements. For sellers, you want to look for opportunities where implied volatility might collapse, such as after events or during calm periods. Never ignore implied volatility. It's often more important than being right about direction. Now let's talk about some common mistakes to avoid when trading options. Mistake number 1, buying options right before earnings without checking to see if implied volatility is already very high. Number 2, selling options when implied volatility is historically low. That can be a very tough trade, and it's often not worth the risk. And number 3, ignoring implied volatility altogether and focusing only on stock direction. Remember, you can be right about everything else and still lose money if you're wrong about implied volatility. Now let's wrap up with some key takeaways. Implied volatility is the market's expectation of future price swings. It directly impacts option prices, sometimes more than stock price itself. Different strategies need different implied volatility movements to profit, and meme stocks have unique implied volatility behavior that can make or break your trades. As always, thanks for listening. Please like, share, and subscribe if you thought this video was helpful. Be awesome.